Alright everyone, Cowboy Trades here. Welcome back to the channel for another update on the SP 500. So this SP 500 chart over on Bloomberg Terminal has called all of the 5 major tops throughout this entire bear market, and it is flashing for the 6th time. We're going to talk about this new chart. We also have 2 new charts that I do want to dive into on today's video and update the dollar for the first time in a long time. Before we dive into that, let's update some of the macro charts we've been looking at. We've of course on the channel been updating you with this 5-wave asymmetrical triangle, which we've been predicting is going to start falling to the downside after we have topped out on wave E. Obviously in the past week or two, the SP 500 has been weakening materially, and it looks like, of course, we have closed a weekly candle right back into this triangle formation. So this is looking like it's going to be a throwover, and now we've got the weekly candle confirming this move. It's looking like this is going to be a failed move equals a fast move in the opposite direction, and we're going to start rolling down. Now, if we come over to the next chart, we're still looking at the same triangle. This is on the daily time frame. We're looking at the individual wave count for all of these macro waves. As you can see, we've quite recently topped out on wave E. If we zoom in on the 4-hour time frame, we've been talking about how this is probably going to start a new 5-wave trend to the downside. Now, in the past week or so, we did manage to retest the top of the downtrending line of resistance on this asymmetrical triangle. And like we said, on Friday, we closed within this asymmetrical triangle. We closed beneath it. We back tested it on the last 4-hour candle after having a nasty bearish engulfing, and we closed right beneath this. So it's looking like on Monday, when we do get that opening, we're going to move all the way back down to this wave 3, which is likely going to find some support around about 3,970, which is probably going to equate to about a 3.7% drop in the following week. We could then potentially expect a bounce and then a further move back down to the downside, breaking us down from this asymmetrical triangle. I just really wanted to quickly update this chart. I know we update this every week, but now more than ever, after we've confirmed this throwover and closed a weekly candle back in the asymmetrical triangle structure, it's looking like this pattern is pretty much confirmed. Now, I want to talk about these 2 new charts over on my screen, focusing on these DXY and SP 500 parallelograms. Now, first of all, before we do dive into these 2 charts, I do just want to say the original idea for these parallelograms on the SP 500 and the DXY is not my own idea. I have people on Twitter who I talk to about economic data and charts, and one of them has sent me this original idea from an economist named Michael Kramer. So I just wanted to give credit where credit's due. I will be doing my own analysis on this chart, but yeah, the original idea for these DXY and S&P 500 Fib Parallelograms was by this economist, Michael Kramer. So like I said, just wanted to give credit where credit's due. Not my original idea, but I will be diving into the TA on my own from here. So let's dive into this. So the main purpose of these parallelograms is just to get an idea using Fibonacci's on whereabouts we are in terms of the S&P 500 and the DXY. Now, starting off with the DXY, you can see we've been trading within this diamond parallelogram shaped object for quite some time, and we have just recently broken out of this, taking out the first 786 Fibonacci, and it looks like we're coming right up to oh sorry, this is the wrong one. It looks like we're coming right up to this 618 Fibonacci. We closed right underneath this, round about 102.3 coming into Friday. Now, why did we have this massive breakout on the DXY? And this is for one very specific reason. It's actually associated with a news event. Basically, there is talks between Biden and Congress that we'll be taking next week in regards to the debt ceiling. Now, Congress is going to be talking about how they are wanting to raise the US debt ceiling, and if they don't raise the US debt ceiling, they will probably have to default on some of their obligations if legislators fail to raise the limit. Now, they also said that if we do default, that's something America hasn't done since 1789, and we shouldn't start now. So just wanted to point out this quick news event. Basically, early next week is rumored to be where Biden is going to be talking with the Congress lawmakers, and they are going to be discussing whether they should raise the debt limit or not. And this is what has the DXY running up right now. Quite recently, a lot of people have been leaving the DXY, leaving the US dollar rather, and this kind of just gives a little bit more confidence back in the dollar that they're not going to be defaulting and all of that good stuff. So With that being said, if you're wondering why the DXY has been blasting to the upside for the past few days, yes, it could be partially because we were coming into the corner, the apex of this parallelogram, but also when this news event happened, this was literally right here, and we exploded out of this as soon as this news came out. So what is interesting about this is we all know there's a strong inverse correlation between the DXY and the S&P 500. So if we load up the DXY chart, you can obviously see DXY up, S&P 500 down. What I now want to do is I want to come over to the left side of the screen and invert the DXY. So we're looking at the S&P 500 with the candlesticks, and we're looking at the inverse DXY in this green line chart. Now, we obviously know that the DXY is a leading indicator for the S&P 500. You can see the DXY topped out right here on the 1st of February. Well, bear in mind, we're looking at the inverse DXY, so technically it bottomed out over here, but just for the sake of this, we'll just look at the inverse DXY. So inverse DXY topped out on the 1st of February, and the S&P 500 topped out here on the 2nd of February. Then you can see that the inverse DXY bottomed round about the 7th to 8th of March. The S&P 500 bottomed on the 13th of March. If we then look at the top for the DXY topped out on the 13th of April. It took a little bit of time because it was chopping sideways and not really doing much. It made a double top, but before that happened, the S&P 500 topped out on the 1st of May, a few weeks after the DXY or inverse DXY topped out. Now, what you can see is now we're looking at the inverse DXY. The inverse DXY is in this same parallelogram as the S&P 500 right now. And the DXY being a leading indicator, as we've just discussed, and you can backtest this further within these charts if you do want to, the DXY being a leading indicator for the S&P 500 is breaking to the downside right now. If I line up the top and bottom absolutely perfectly, you can see the top lines up with the top for the S&P 500, the bottom lines up with the bottom. They're now in the same parallelogram because we're looking at the inverse DXY. If I right click over on the DXY screen, invert the scale, this is just what we're looking at here. This is the inverse DXY, this is the inverse DXY overlaid on the S&P 500. So with that being said, with the DXY breaking up, tanking above the 786 Fibonacci, with this incoming potentially bullish news for the DXY about the debt ceiling being raised, well, temporary bullish news that they're not going to be defaulting, we could see further continuation up in the DXY, which obviously means further continuation down in the inverse DXY, and this leading indicator could be meaning we might see the trend materially weaken for the S&P 500 as we do break back down to the downside. Now, if we correlate this chart with the diamond parallelogram with other indicators, other charts that we've been looking at on our own channel ourselves, this makes a lot of sense. Right now, you can see that the S&P 500, as we've been talking about on the channel, is breaking back down, closing weekly candle bodies back in this asymmetrical triangle, showing major weakness right now. I at least think we're going to move down to about the heart line where the bull market support bands are in the next week, down about another 2%. On the channel as well, we quite recently highlighted that corporate insiders were selling. As a reminder, we also talked about the daily MACD putting in its first cross since the 10th of February, and we have been moving down and weakening since then. We've also talked about this major price gap down at 3,580. Do bear in mind this is a macro target. This may take a long time to come and fill, but this is about a 13% drop in the macro. So yeah, just wanted to share a few technical thoughts in the news on what is happening in the markets. Do bear in mind, once again, this debt ceiling meeting early next week is going to be extremely important. One final thing I want to quickly touch on before we do dive into this new chart on Bloomberg Terminal regarding the options sentiment is actually what's happening in the options market itself. Now, if you do watch my channel that I don't cover options too often, the main reason I haven't covered options in a while is because we've seen the call price wall and the put price wall remain relatively stagnant for quite some time now, but the put price wall is actually slowly starting to decrease, while the call strike price wall is remaining the exact same level. Now, to some of you who don't understand options, it may sound like I'm speaking in a foreign language right now. I've actually just recorded a options educational series update, which is going to talk about everything you need to know from the fundamental perspective. What are calls, what are puts, what are options, what are strike prices, expirations, what does it mean when the call wall and the put wall isn't moving whatsoever. I've recorded a 10-minute educational series update, so if you do want to understand this in a little bit more detail, you can go check that out on the channel. I haven't yet uploaded it because I literally just finished editing it. It will be uploaded before this video comes out. But what you really need to know is basically in the options world, puts are basically like stop losses for trades, and calls are basically like take profits. Now, calls are also buys, puts are also sells. For example, if you were expecting the S&P 500 to rise, you may purchase a call on the S&P 500 at the strike price of, let's say, 4,200, and the S&P 500 is currently trading at 4,000. What you're basically hoping is for the S&P 500 valuation to rise above 4,200. Let's say you're hoping for it to rise to let's say 5,000, nice round number. You're hoping for the S&P 500 to rise from 4,000 to 5,000, and subsequently you can call for a purchase at the strike price of 4,120, meaning you can purchase the S&P 500 at 4,120 even after it's risen to 5,000. Like I said, I'm flying through this, and if you've never heard about, how options work fundamentally, like I said, it may sound like I'm speaking a foreign language. I do recommend, if you want to learn more about it, to come over to my YouTube channel and check out the most recent educational series update, which will be out by the time you're watching this video. What I really want to highlight in this chart is that I've been looking at this for the past few months, and the strike price for the call wall has absolutely not moved whatsoever, meaning that people who are purchasing calls, hoping that the price is going to rise above their strike price, their strike price wall has just been stuck materially at this gamma level at 4,120. Gamma level meaning that it's just heavily concentrated at 4,120. We're organizing this by volume right now, and as you can see, if we organize this by volume, the majority of gamma is at 4,120, 4,125, 4,115. The strike price on the call wall has been absolutely sticky and stuck here for months. So options traders on the call market are showing major weakness right now. This is why we're seeing the put to call open interest level almost at 3, meaning that there's far more interest for having put sells rather than having put buys. There's also a little bit more of a gamma level on the put strike price at 4,100 than the call strike price at 4,120. Not by too much, but this really just emphasizes that the gamma on the puts is a little bit more stronger than the gamma on the calls. And if we do see the S&P 500 start to weaken further from where it is right now, as we've talked about in these leading indicator charts, then it may look like the S&P 500 is about to break down, and we may see a lot of these puts get sold into the open market at higher valuations. In general, seeing a really high put to call open interest ratio is bearish for the markets, and this is what leads us to our final charts. Now, if you have a Bloomberg terminal, you can open this options sentiment chart. If you don't, at the end of the video, I'll be showing you how you can get this free indicator over on TradingView. It's not as good as a Bloomberg terminal, but nonetheless, it is free. So what I'm looking at here is the S&P 500 options market sentiment. What this basically shows us is kind of what we looked at in a bar graph down here with the put to call ratio. What we can see over on this Bloomberg terminal chart is that the put to call open interest ratio is rising, and the put to call skew ratio is absolutely rocketing right now, making new all-time highs since this bear market has been in fruition. So what does this show us? This simply just shows us that there's far more interest in the options market for puts than calls. As you can see, when it's topped out these 5 previous times in this entire bear market, it has almost exactly called the exact top in most of these macro moves. Now, you can actually see there is one spike here. I didn't consider this a macro move, but I did also just want to highlight this did correlate to a spike in the put to call ratio. In my opinion though, looking at this chart, these are the major spikes, but I haven't omitted this data point to not fit my narrative. There was also a spike in the put to call ratio over here. With that being said, it is spiking up to all-time highs right now. So this is the 6th time in this entire bear market that we've seen this spike. What do you think is going to happen next? Well, I think history is pretty clear on this one. It makes a lot of sense for all of the reasons that we've looked at in today's video, that the S&P 500 should begin to weaken and break to the downside of this diamond parallelogram, break to the downside of this asymmetrical triangle, and continue this new wave count back down to the downside. Also, like I said, I understand not everyone's going to have, $30,000 a year to pay for a Bloomberg terminal. This is really only accessible to economists. That being said, if you do want a similar, not as good, but still pretty good chart where you can look at things like the accumulated P to E ratio, and for example, if I highlight some of the tops over in this P to E chart, you can see it's not always as accurate as the Bloomberg terminal one. Nonetheless, it is more or less pretty much accurate. What you can see here is this is just the accumulated put to call ratio. If you come over to the indicators and just type in that, accumulated put to call ratio. This is the one that I'm using, put to call ratio V2. There is also the original one. I find that V2 is a little bit more accurate, but the original one has more data traded if you wanted to go and back test it. So for today, my friends, that's all I've got. If you are enjoying these new posts that I'm doing with new economic data on the Bloomberg terminal, then let me know in the comment section down below. The previous one got some good responses. If you want me to keep on covering these Bloomberg terminal charts, let me know down below. I'm definitely enjoying encompassing these in my data outside of just the regular trading view charts. With that being said, that's all I've got. If you do enjoy my content, let me know down below by leaving a like and a comment. Share the videos with your friends. If you want to further support the channel, feel free to click the join button and become a member today. Follow me over on Twitter at 618_cowboy so you can be privy of these news events, economic data, and charts before I do post them over on YouTube. I'm out. Peace.